Hey Shane, how's it going?
It's going well, man. I'm not on vacation, so I guess it's going better for you than me. But yeah, good overall. How are you?
It is. It's going well. And I'm over here on the West Coast in California, so getting a little more, full view of the nation. And it's interesting. I was telling you before this, staying in a business district out here and total ghost town. So it's like having our own private resort. So it's
Yeah, I call
interesting.
it I call it California.
Yeah, well, today's August 11th, and boy, it's been interesting in the market the last few days. So, CPI came out. We just had PPI come out. Um, Maybe we're breaking new highs. I don't know. I'm skeptical of this rally. We'll go to the first chart here, and maybe you can add some color to it.
Sounds like a plan.
All right, so we got the SPY up, and we've talked about this one, but here we are today. Broke up. We got this candle that can't decide if it wants to be red or green. So, we were just adjusting some of the slides trying to get it right. But today is still to be determined how we're going to finish. What are your thoughts on the big picture here?
Yeah, I don't know. The SPY candle seems decidedly red. The SPX and the SPY are not exactly the same, so it's a little bit different there. But yeah, I mean, we've definitely broken above the high from like June 2nd.
Hmm.
Which I think where that green line is at 417. So we're trading above that now. Ironically, something I don't think we have a slide for, June 1st is when the Fed actually started reducing its balance sheet by $47.5 billion a month. And maybe we'll have to go find a Fed balance sheet chart. But anyway, that's when they started. And you can see what happened pretty shortly thereafter. I don't think that's exactly why the market fell to new lows, just because the Fed started letting assets roll off its balance sheet. But starting September 1st, they're going to double that up to like 90 billion or 95 billion. I can't remember the exact number. But they're going to double it and it's going to get much bigger. So they're, yeah, 47 and a half to doubling is 95 billion. So that'll be a lot of assets that are not being replaced by the biggest buyer in the bond market. That should cause interest rates to go higher. As interest rates go higher, everything gets discounted using a higher discount rate, which means present values drop. So I think there's a limit to how high the market can go. We're still trading under the 200-day moving average, but getting pretty close to it. Still trading under you know, the trend line, the purple trend line there of the highs. So hopefully we'll just put in another lower high and um, drop back down. Whether we need to make a new low or not, I don't know. But it'd be nice to at least see the market drop back to the towards the 50-day moving average, that red line there, and maybe consolidate for a real move higher. I have my doubts though, given the current economic environment, actions of the Fed. Just in general, things don't really seem that good. Prices are incredibly high. And not falling. Just because prices aren't inflating by as much does not mean that prices are going to drop. They're dropping in some parts of the economy though, like new home sales are reporting lower prices, and cars are going to get discounted here soon because the inventories are creeping up. So I mean, there's a lot of moving parts in this economy, but I think there's if anybody read my market commentary, which came out, I don't know, was that yesterday or the day? Yeah, I think yesterday, along with CPI. That there's a lot more reasons to be bearish, in my opinion, than there are to be bullish. But right now, the market is, I think, experiencing some FOMO, lots of FOMO going on. And when portfolio managers who manage billions of dollars start getting FOMO and just paying any price for garbage stocks, you can be sure that the end of the rally is probably close. So we'll see if that's what's happening. I kind of think so. And markets don't go straight up or straight down. So a breather here and a pullback at least to the 50-day moving average, yeah, I think is coming. It's just a matter of when.
Yeah, and I agree with you there. Something I look at a lot is, when you look at just the chart, when you get a rally like this, I want to see it pulling back and building a solid base before it's going higher. And right now, this looks like a sugar, fueled rally that's gone up quick, but I don't know if it's going to have staying power. So it'd be nice to see it consolidate. And here's the bigger thing here, we talked about this. It's not a line. So it's not an absolute number that, okay, if it breaks this number, we're breaking out. And here we are in this box, and we may have broken out, but I want to see it hold. I want to see it come back, test that again, and work its way higher. Right now, it's just kind of the perfect recipe in a way of everyone starts getting FOMO, jumps in, and then if they find out they're on the wrong side of the trade, that's where you get those really sharp sell-offs.
Yeah, FOMO, by the way, is not an investment strategy, just in case anybody was wondering. That's not how you make money in the stock market. So, FOMO is just one of those things that happens to everybody, but it is not a sound investment strategy. So, if you have the FOMO indicator, that's usually a time to start getting short, not time to start getting long.
Yeah. And this is one where personally, if I'm managing some of my own portfolio, I'm thinking about trimming a little here. It's a nice spot where you could trim a little, let it come back base, and then if it does want to go higher, you could get back in there. But this is just a spot where what I don't expect is to see it just rally right up here within the next few days. Odds are we're going to see a little bit of a pullback and consolidate.
Yeah.
So, all right, here's the next one. So, oil, we were talking about that. It broke trend, but it looks like it reclaimed that trend. Personally, I'm feeling bullish. I've big picture, I've been bullish throughout, but when you see this where it breaks and reclaims, I think that's saying it's probably going to go a little higher, but it's going to take time. It's not just going to bounce and race higher right out of the gates.
Yep. Crude oil, you can get constructive on that. I think still below the 200-day moving average, so that'll represent a little bit of resistance there in the near term. But but yeah, I mean, we'll see what happens with oil. I think it's fairly priced at the moment. I don't think it needs to be 120 a barrel. But I don't really see it, going down to 60 or 50 a barrel anytime soon. So, maybe just some more consolidation. Let the 50-day moving average, that red line there, come down and kind of meet and greet the 200-day moving average, the blue line, and as those tighten up, then it can expand from there in one direction or the other. We're definitely staying long the oil stocks at Elevate. So maybe adding to those down here at these levels, and yeah, I think the upside is there. So um, I wouldn't. I'm not trading it personally. It's not something that said, I do have Occidental Petroleum in the portfolio. I looked at adding the double long oil producers, the ERX ETF over the past couple days, but I couldn't quite get comfortable with it. So I'm not in that one. Just a little bit of Oxy.
Yeah, that's a good one. And that's Warren Buffett's favorite too, isn't it?
I don't know. I mean, they say Berkshire Hathaway has been accumulating some Occidental Petroleum, but I'm not sure how much Warren Buffett's actually making trades over there these days. I mean, gosh, it's too bad we don't have TradingView up on the screen right now. But last time I looked, Berkshire Hathaway, the stock was absolutely getting just not looking very good. I wonder if that's hey, it bounced a little bit, so it's getting back up to the 200-day moving average too. But yeah, I don't know. I'm not sure how many of the decisions he's really making at this stage of the game. I know he's got a couple other portfolio managers over there um, that seem to be buying things that he wouldn't historically have bought. Like an oil company is really not that capital efficient. He's known for buying capital efficient stocks, Coca-Cola and Hershey and insurance companies and so on. He is not known for buying airlines and oil companies. I mean, he's done it, by his own accord more than once, but it's not his normal thing. So I'm not sure if he's making those trades or somebody else, but yeah, Berkshire is taking a pretty big position in Occidental, so that's cool.
Nice. Well, now gold, that's one last time we talked about looks like a nice breakout off this downtrend resistance line, but yeah, gold loves to frustrate people and we had a pretty rapid bounce off the lows here, broke through and looks like it's consolidating here. We'll see where it goes from there. It's never been a clean trend and hard to say. So I'm not making any calls here, but I wouldn't be surprised at all to see us move sideways and consolidate here for a while.
Yeah, that's 7.5% off of the lows there. So it might look like a lot, but it's not very much on a percentage basis compared to the things that I like to trade. I like things that move 3 or 4% a day, not 7% over the course of 30 days. So I don't think it's a good trading position. It looks like the momentum, looking at the bottom of that chart. I don't know if you want to put your little red dot over it, but the MACD, now the momentum. There
Oh
you
yeah,
go.
down
So
there.
that it looks like the momentum's starting to roll over to me. I mean, that was the point where it accelerated, it turned green. I'm saying right now, today, it's beginning to it's positive momentum, but at a declining rate of positiveness. So looks to me like it needs to pause here, at least, if not drop a little bit, and then see if it's got some juice for a rally higher. But again, 200-day moving average overhead, plenty of resistance there. It's not something that I'd be buying for a trade.
Yeah. And like you said, not a fast rate of return, 7%. Compare that to what stocks can do. It's not a whole lot, just a
Yeah.
good chaos hedge.
Gold is a chaos hedge. That's what it is. You got it.
So, and then here's Bitcoin. Yeah, I'll call this a bear flag. I'm not really convinced on this rally. I want to see it go over this line and then I'll be a bull, but it just still it's kind of like gold. It's really just a good way to play a guessing game right now and see if you can get it right, but nothing clear going on.
I honestly, I'd like that. I think I'm going to add to my Bitcoin position here soon. I don't think I'm going to bet the farm on it, but I like that it has put in what we got: one, two, three, four higher lows now. Um, and it's above the 50-day. So I told you the 50-day was my stop on yeah, it looks like we got that the 50-day moving average is covering that purple line. So I don't know. To me, it's holding that level. As long as it holds that level, I think I'm pretty constructive on it. And so we had the MACD actually roll over and turn negative a few days ago. So momentum tried to go negative, but didn't last. Got buyers out of that and rallied higher. So um, yeah, I'd rather be long Bitcoin than gold at these levels. So
Yeah.
again, tight stop though. Stop at the 50-day moving average. And so if you're wrong, you're wrong.
hmm And so Shane, it's funny we both have different views on this, and it brings up a point is that investing in things the importance that can have on your success. So I don't do Bitcoin a whole lot. I think I've tried twice, and you've done it more. So for me, I really need to see this convince me that we're going into a bull market. Whereas, you are familiar with this, so you start to feel that comfort level, and you can get in and start building positions like you are. And that's just always something I think people need to remember is that when you build a portfolio, it's always important to kind of go with some things that you're familiar with because you can end up staying in positions a lot better. Any thoughts on that?
Yeah, I mean, I'm sure that has something to do with it. To me, it's just, dude, I trade so many things where I don't have any idea what the company does, or I don't know how they claim to make money or I don't care. I see the chart, I see the volatility, I see the behavior, and to me, that's good enough. I've seen enough charts in my day that I can buy and hold on to anything. I can set a stop at the right level. Like the big difference is that gold looked like it made a big move. If you flip back to the chart, it looked like it made a big move compared to what Bitcoin looks like
Mm-hmm.
on this chart. The difference, though, is that gold moved 7% off the lows, and Bitcoin has moved 38% off the lows. That's the difference. I
Yeah.
mean, that's why I look at the average daily range. Like how much does something actually move, on average each day? And Bitcoin, it moves a lot. Gold moves like not at all. And so, in fact, I can quantify that a little bit. I think if you give me a second, Bitcoin's ADR is 4.58%. So it moves on average 4.58% every single day, one way or the other. That's just a normal day for Bitcoin. Gold is 1.2%. So, I mean, it takes gold 4 times as long to make the same move as Bitcoin will make. It's to me, it's just you don't trade these low volatility things. What you want to trade is you want to trade things that are high volatility, set your stops in the right place, and that way, if it's going to go higher, it's going to go higher quickly. I
Mm-hmm.
don't I don't have all day to be sitting around waiting for this stuff in my personal, trading accounts. Gold is something that again we use as a chaos hedge for long-term portfolios. own some gold in my safe personally, but I don't necessarily trade the futures. Don't get me wrong, there are some setups where it's like, okay, gold's really moving. It's behaving abnormally, and it's behaving abnormally to the upside. Like back in early 2022, like that was a pretty decent trade. It was actually ripping higher like every single day. It was moving by a lot. So you can identify those regime changes and take advantage of them from time to time. But on average, Bitcoin just moves so much faster than almost anything. I mean, it moves like an option moves. So um, that's what I like. When I'm trading, that's what I'm looking for is things that are high volatility. As long as the volatility is going the right way, that's how you make money.
Yep.
And if it's not, that's why you use tight stops so you get the heck out before you lose 8% over the course of 2 days. So anyway, yeah, I mean, I am comfortable with it, but not just because I'm comfortable with Bitcoin. It's more like I'm just comfortable with the mechanics of pretty much any chart. Like that's what I love about technical analysis is I don't need to know. I don't need to know what the fundamentals are. A lot of times, and I think we've talked about this in this chat, like a lot of times the news comes after it's shown on the chart. You see a big move, either up or down on big volume, and there's no news for it, you could bet the news is coming out in a couple of days. There's going to be news on that thing more often than not. It didn't just move for no reason. It moved because somebody has advance notice of that news and they begin to take a position. And as they begin to take a position, other people like me who are scanning for that see it and they're like, wow, there's a lot of volume on this move. I don't know what the news is going to be, but I like it and I want to take a position. And I can't tell you how often that works out as a trade. A lot of times those moves get erased very quickly, over the subsequent days. Um, so you got to be nimble, but nothing's perfect, but those are the kinds of things that I like to look for.
Sounds good. So now here's the next big one. There's been a lot of talk of yield curve inversion, and this is one of the big fundamental underliers. And this is where, when you see a rally like we're having, it's very hard for me to get behind it when you're seeing the yield curve to hit inversion levels that we haven't seen since 2000. What are your thoughts on this?
My thoughts are that it's ugly and bad and it's dropping at an accelerating rate. And it's funny the banks are up a lot today. I don't know why. Banks borrow money for a short term and lend it for a long term. Right now, they're totally upside down in that. Um, it just makes no sense at all. That usually is a leading indicator for the economy. If the banks can't make money in their principal operating business, they tend to stop loaning money to people. And so it's usually not a good sign. I can't imagine anything bullish about this being the case. And again, just to be clear, what this says is that you can earn a higher rate of interest loaning the government money for 2 years than you can earn by loaning them money for 10 years. It's totally backwards. I mean, imagine, the wealthiest, cousin you have in your family, right? Who totally can afford to pay back a loan, um, isn't going to have any trouble, coming up with the money to pay back $1,000 loan. Imagine they wanted to borrow $1,000 from you for 2 days, and then or 2 years, call it, and how much interest would they be willing to pay you? Probably a small amount. It's a good bet that they'll be able to pay you in 2 years, and it's not a very long term. Now imagine the same person comes in and says, well, hey, I want to borrow money for 10 years. Well, again, they're probably going to be able to pay it back. No real worry about defaulting on that loan. But since it's 8 extra years worth of time, 8 extra years that you don't have that $1,000 to invest in stocks or bonds or real estate or anything else, you say, well, hey, because you're going to have my money for 8 extra years, I need to get a little bit more interest than if I had just loaned it to you for 2 years. That'd be normal. Um, but that is not what's happening right now. Right now, again, you would be loaning money to this person, and getting a higher rate for 2 years than you would for 10 years. So the question is if your cousin was willing to pay you a higher interest rate to borrow money for 2 years than for 10 years, would you loan them money for 10 years? No, you wouldn't. You wouldn't even do it. So it trips me out that there's not more of a rush of people looking to loan money to the federal government at 2 years to bring that rate down. Just hasn't happened.
Hmm.
So to me, it will happen, right? Eventually, this thing will stop going negative. But I've heard people calling for, negative spread here as much as 2%, which is going all the way back to like the 80s. Very similar to the environment we're in right now, right? With very high inflation and all that kind of thing. So, um, wouldn't surprise me, but that usually doesn't lead to a good, healthy economic environment or lead to a bull market. It usually leads to declines in asset prices. So this is extremely bearish, and I don't know if like the whole world is just asleep at the wheel or think this time it's different or what, but this is a major indicator of very bad things to come.
Yep. And the follow up to that, so CPI, so that's the other big one is how these all tie together. So, raising rates against rising inflation, and here we are, we got the latest CPI print, and the chart at the bottom, so that is the month over month change. And the over month change for July was 0, but I think this is the big number we all want to look at. So we might change less month over month, but we're still sitting over at 8% inflation. I, that's not good. What are your thoughts?
It's just funny I mean, this is all about base effects. So if you've read my commentary at all, I've talked about base effects kicking in. So how is it possible that the year over year inflation dropped, right, from 9.1% to 8.5%, but the month from one month to the next, inflation didn't change at all? How is that possible? I'll tell you how it's possible. Is the base number that you're using to calculate is what changed, right? So the higher the base level, the harder it is to maintain the same rate of increase. So again, inflation didn't drop over the past month. Prices did not deflate. They just didn't grow. And from last month, well, I guess from June to July, we now use July of 2021's inflation number to calculate the year over year change in July of 22. So it's that July 2021 number that is so much higher than or excuse me, the July 2021 number that was higher than the June 2021 number. So the reason that year over year inflation is because of inflation's behavior a year ago, not a month ago. So while the market's getting all excited and buying stocks because, inflation is peaking and so on, it doesn't mean prices are coming down. Sure, prices of some things are coming down, but across the board, prices are not coming down at all. They're maintaining, they're stubbornly and persistently high, higher than they've ever been, in anybody's lifetime, and they probably won't ever come down. These gains in price probably won't ever reverse. Like deflation does not happen very often. It's an extremely rare thing to see prices actually decline because, again, that's why the Fed has a stated goal of keeping inflation at 2%. They don't want it at negative 2%. If you knew that prices were going to go down every month or every year, how would that impact your spending?
You wouldn't spend, you'd wait, right?
That's right.
Wait
If
for
you
the
want to
really
buy
good
a new
discount.
TV and you know that prices are going to go down next month, what would you do? You would wait as long as you can. So the idea behind inflation is that it encourages people to spend the money they have sooner because prices will be higher down the road. It's a very simple thing. So back in 2008, 2009, we actually saw deflation happen, and we all know how many people ended up homeless and jobless and how long it took the market to recover. So the Fed will stop at nothing to make sure we don't see deflation. Like you have no idea how much money they will print if it looks like prices are actually going to start falling. So the pri here's and this is the big problem is that these price gains, they're permanent. Like we're not going to see deflation. What that means, if you carry it forward, is that the income inequality in this country in this country has permanently worsened yet again by orders of magnitude. So if you thought, the rich kept getting richer and the poor kept getting poorer before, it's so much worse now than it was a year ago, and it's never going back. Um, not without substantial pain in the form of deflation, which will be contagious for the entire global economy, and just a whole bunch of really bad things will happen. So it's unfortunate, but the poorest people in our country, will permanently have a harder time paying for food, for gas, for a roof over their heads. And it's never going to go back to the way it was. So I don't know how that's good for the economy. I don't think it is. Um, and maybe it'll work out that the stock market doesn't care, because the rich people are the ones who buy all the stocks anyways, or at least 80% of them. So the economy and the market are not the same thing, but what this indicates to me is that the economy is not in a very healthy spot. It goes perfectly with the previous slide we looked at about the spread on the tens versus twos, just all things that indicate the market is not, excuse me, not the market, but the economy is not in a very good place.
Yep. So, and then here's the other one too, is if things get more expensive, well, jobless claims are starting to go up, and what does that do? Well, if you have fewer people working, that's fewer dollars chasing goods. That's disinflationary. Fed might be going after that one, but any thoughts you'd like to add on this one?
No, pretty self-explanatory. As rates go higher, uh, jobless claims should increase. And somehow, because of the way they do the math, the unemployment rate continues to decline. I guess the one thing I would add is that labor force participation rate is not very high, but close to 40% of the people in this country who, can and should go get a job are they don't have one and they're not looking for one. So when only 60% of the people in the country even want to go to work, let alone can go to work, it's easy. When you're only using that 60%, the people who actually want to work, when you're only using that as essentially your base rate, like the base effect, it's easy to have a low unemployment rate. But if you included those other 40% of people who aren't working and don't want to work, uh, the the unemployment rate would be substantially higher. I don't know how high it would be, but it would be very high.
Yep. And then here's the other one. So, when you're talking valuations in the market, price to sales ratio here, with it just sky high, doesn't make me want to jump in, but any color you wanted to add on this one?
Um, Not really. I mean, just a quick comment. Like, all we've done is erase like the frothiest part of the move. This was like down more towards the lows. So when the market was trading at its lows, it was still at the extreme high price that we reached during the dot-com bubble and back in 1929. So the price to sales ratio, on average for the S&P 500 is basically the same now as it was in 1999, 2000 before the dot-com bubble burst. And it's the same as it was in 1929 before the Great Depression started. And the market's down, was down, say, 20%. NASDAQ's still down 20%, mind you. But the move lower this year wasn't really that big of a deal. We moved lower, but everything was still incredibly expensive. That's why even though we dropped by 20%, more than 20% the S&P 500. When we were doing fundamental analysis looking for new stocks to buy, we couldn't find anything that was really cheap. Prices were down 20, 30%. Nothing was cheap still. It was still all crazy expensive. And, it's just a function of how much money gets printed, pumped into the system all the time. So, yeah, we've only erased the most frothy part of the bubble and everything that has happened since COVID, which is just crazy to me. But maybe it'll go all even higher. Who knows? I have my doubts, but well, I'm wrong a lot.
Yeah. And then here's his last one is so the fear and greed. We've talked about this before, but you know, being the one that jumps in, chasing after everyone else trying to get in, that's greedy. It's not always the best way to invest. What are you seeing off of this?
Yeah, I mean, I guess we don't have that box in a very good spot because I adjusted the size of the slide, I think. But the annualized return when we get to this type of a greed level is negative. So above 80, the annualized return for the S&P 500 is negative 30 basis points. So just not a lot of upside there. Um, back in May, when it was trading below 20, that was a good time, good odds to maybe put some money to work. Um, but at this point, it seems to me like we just due for a pullback. Um, so yeah, there's some stuff on the left there. If y'all want to pause and read the comments on the left, these come from our friends at Sentiment Trader. That's where this analysis comes from. Um, but really the bottom part of that writing, right, where I have it bold, over the next 3 to 4 weeks, it'll tell us a whole lot about the prospects through year end and beyond. So we need to see if if this is a moment in time where the market's just going to keep pushing higher, despite a whole bunch of really major reasons to be bearish and pessimistic about the economy overall. If that happens, like you can't fight it. You can't fight the tape. If the market wants to go higher, it's going to go higher. If there's so much cash sloshing around and people want to put it to work, they're going to keep putting it to work. And the higher the market goes, the more they're going to feel FOMO, the less they're going to care about what price they're paying to buy, and the market will continue to go higher until someday it doesn't.
Hmm.
So we'll see what happens. But I just think this is another, kind of major reason to be pretty cautious about putting new money to work at these levels.
Yep. And to tie everything together on the greed, we have this slide. This is the biggest thing is that if we are in a bear market like this, you can see times where similar to '08, a 14% rally, 9, 20, 26. So there could be some of these rallies that make you want to chase things higher. It also can make you feel like, you're missing out and some people won't get back in and they'll wait a little bit, which, seems like the prudent thing to do. But um, just one good rally like we've had right now, it's just not the most convincing, and especially when the fundamentals aren't really turning, they seem to be deteriorating, especially, the on the yield curve inversion. That's kind of the big one that stands out to me.
Yeah, I mean, again, I have no idea if this is true or not. It feels to me like we were mostly in that very first rally where in this case, the market rallied about 14% from below its 50 day moving average up to its 200-day moving average, broke through the 200-day moving average for a couple of days, and then failed and started to drop. So that's where it feels like we are, to me. Um, if I had to draw like a direct comparison to the '08, '09 situation. Um, Again, we don't have a mortgage and banking crisis right now, so there's no reason that the market has to drop 57% from its highs and take a year and a half to do that. So I'm not saying that this is the same as the great financial crisis, but there are a whole bunch of other really kind of bad things that are out there. The thing about the great financial crisis was that nobody really saw, well, very few people saw the mortgage crisis actually happening. People it came out of nowhere to a lot of people. There were a few people who saw it. They made a movie about it called The Big Short. So if you haven't seen that, go watch it. Um, but one funny thing about that though is that it's so hard to make money on the short side. I mean, the market normally goes up, right?
Hmm.
That's what it normally does. It's so hard to make money on the short side that when somebody actually did it, they made a movie about it. So you don't want to be a perma bear. When the market wants to go higher, it goes higher, and you better get involved if you want to make money on the upside. So yeah, I don't think we're out of the woods yet personally, but that doesn't mean we're not buying stocks because just because I think we're in a bear market and it's going to probably get worse and put in new lows doesn't mean that it will or has to. So you gotta be able to balance competing ideas in your head to be good at this game.
Yep. So, well, Shane, thanks again for taking the time this week and look forward to catching up next week. We'll see though, we're at an interesting place in the market and we can have a very different conversation next week. So we'll
Hey,
see
do
what
you want to
happens.
quickly just jump over
Sure.
to the market commentary? Do you have that queued up?
Yep, it's right here.
Yeah, so everybody, if you want to check out my recent market commentary, which was again posted yesterday, it was mostly written on the 9th, but posted yesterday. The first part of it, which Kyle's kind of looking at right now, it covers trailing stop losses and how we use trailing stop losses to protect our gains, protect our capital from the outset, and determine our position sizes. So I think it's a pretty cool thing. Obviously, I wrote it, so I'm biased. But also, if you just scroll down a little bit, there's to the first chart that you're going to see, and maybe just click on that chart. So here it is. Um, Checking out stop losses. This is analyzing one of Warren Buffett's trades. He's the guru in this case. So this is a buy of CVS back in 2011. He bought it and then sold it, at the end of 2012 when it was dipping from its highs. Made a really nice gain. He made 15% in about a year on the trade. 15% a year is a great trade. Problem is that the stock ended up going up more than 100% from there, and so instead of being this is the biggest misconception about trailing stops is that people think it's just for active traders, but nothing could be further from the truth. I mean, we use trailing stops to keep us in trades for a longer period of time, because as long as the stock stays above this red line here, where it says SSI stop loss, which is basically you can translate to a volatility based trailing stop. It's kind of dynamic. So the percent trailing stop you use is adjusted for the historical volatility of the stock. Um, you can see as the stock continues to climb, the red line continues to climb until the stock drops below the red line, and then we get out for about 160% gain in this example. So I just think it's a cool thing that not a lot of people know. Certainly not a lot of advisors talk about, but is become instrumental in my personal investing. And even trading to some degree, because when I get into a good trade, even in my more active personal trading accounts, I use a trailing stop, usually the 10-day or 20-day moving average, to show me when to get out. As long as the stock stays above its short-term moving averages, it's going up. And when it finally drops below them, it's a sign that it could be done going up for a while. So yeah, if you want to back out of this, I think that's worth a quick look. So Kyle will post the link to that in the notes, and then at the bottom, more towards the bottom, I go through reasons to be bearish and reasons to be bullish. There are 5 reasons to be bullish that I came up
Hmm.
with, and 14. Oh, actually, click that second one right there, the Fed balance sheet. So we talked about this a little bit in our chat today, but you can see that the Fed balance sheet has started to drop, but only a very small amount from its peaks. As they start letting assets roll off in much bigger magnitude in September, interest rates should begin to climb even higher. So we'll see how the market takes it. But we're in our last month of 47.5 billion here in August, and starting September 1st, it'll jump to a max of 95 billion a month. So that's the Fed balance sheet. Back out of that.
Yep. So,
Can you close that?
oh yeah.
Yeah, so if you scroll through here, you'll find 14 different reasons to be bearish, complete with a whole bunch of different charts, some of which we went over last week in this chat. The White House and their recession comments are pretty funny. Credit delinquencies is another big one that I think is kind of scary for the economy. Price to sales ratio we just talked about a minute ago. And anyway, so all these 14 don't even include Ukraine conflict or the new China-Taiwan situation. So there's a lot to discuss, but I think it's again, I'm biased. I think it's a pretty decent commentary if you want to check it out. So that is all I for now, Kyle. Did you have anything further before we call it a day?
That is all. So hope everyone, checks out the commentary and then be sure to like and subscribe our video and we'll see everyone next week.
All right, enjoy the rest of your vacation, brother.
All right, thanks. See ya.
See ya.